Good morning, and thanks for joining us here on Condo Solutions every Monday morning from 9 to 10 o'clock or thereabouts. We talk about things that have to do with condos, HOAs, co-ops, or any other issues relative to those types of entities. Here to help you answer the questions that come up day to day in your condo or homeowners association, some of the issues that you may be dealing with. It is a call-in show, so we welcome your participation. You can call us at 220-9788. That's also 220-WSTU for those of you that like letters better. You can also, Stuart, 220, Stuart.
WSTU, yeah.
Yeah, 9788.
Yeah.
Remember the old days where you ring up the phone? This is in your day,
yes,
right, Frank?
That's
you
right.
ring up the phone. And
I still remember my dad's first paint store in downtown Detroit back from the 50s. And that was Valley, VA. 222, yeah, 93.
See?
Yeah.
That's what we should do.
Yeah.
I don't remember what ours is. Somebody probably listening does.
Yeah.
But anyway, we're here to answer your questions, 220-9788. Try to give you some help. You don't have to give us your name. You don't have to give us your association. We prefer that you don't give us your association because we might have some connection with it, but also because it may also be a situation that some other listener thinks it doesn't apply to them. And as those of you know that listen all the time, there's a lot of stuff that applies that you don't think so. And a lot of other associations are dealing with things that you didn't realize they're dealing with. So we're here to help with those kind of things. We also try to give you the best answer we possibly can, but we don't have your documents. So we give you what we call a radio answer, which means that we base it on what you tell us your documents say, which we know that can be confusing sometimes, and they can be conflicting, even in the best cases. And so we try to give you the best answer we can based on your interpretation of the documents and based on state law and rules and regulations and common practice, things like that. That's also the reason why we tend to talk a little bit broader, maybe beyond your problem. It might not be the exact situation you've got because we're trying to potentially provide some information to a listener who may have a similar situation but maybe not exactly the same. And so we're going to give them a little bit more information. My name is Mark Breckbill. I'm a CPA and a licensed community association manager, and you guys don't care. The big thing is Peter Mullengarden is our attorney, and Peter's here.
He's the one that we care about.
That's right. Yes. He's the one that everybody knows and loves and wants to call in to ask questions about because he's the attorney that's been doing this most of his adult life.
Right.
Actually, all of his adult life, I think. So you can call in. Peter will answer your question.
And I will attempt to connect the call.
Yes, that will be good. That's always a feat when Frank's on board. It's always
a challenge.
It's always a challenge.
Yes.
But we'll make an effort. And which brings up a good point. If for some reason that I don't know if we've talked about it before, but just so our listeners know, Peter's on the phone as well at this point, and so he has to be put on hold from time to time when a call comes in. We can't answer that call while he's on the air, and he's got to be on hold when we do that. So from time to time, we have to shut Peter up and go to the call. So just so people know, we're not being rude to anybody, but we do. But sometimes we can't get the call, and if we don't, we'd encourage you to call back. And Frank will get you on and as quickly as you can. And if we're dealing with another problem, we will finish that first. But if we're just talking about general stuff, feel free to interrupt. We have no problem with that because we want to answer your questions. So that's about it for the intro. The show's about half over now, so we're good. 220-9788, 220-WSTU. Good morning, Peter.
Good morning, Mark. How are you?
I'm doing very, very well this morning. I can't complain much, I guess. It's not a bad day. It was a little nippy last night, but turned out to be pretty nice this morning so far. So it's looking pretty good. Hey, I was going to mention while waiting for a phone call. I was dealing with some stuff, and I think we talked a little bit about it last week. But I kind of want to mention it again, just for property managers and board members out there. because it's an issue that they may be facing, and that is hurricane loss and hurricane damage. And so the accounting for that is different than most people think. And, it's kind of funny because we talk all the time about how condo associations and homeowners associations are fairly complicated entities from an accounting standpoint, and they're really commercial businesses, and they're big commercial businesses. And we have a law now that requires that you have audits done if your revenues are above certain levels, and reviews if they're above other levels, and that type of thing. So many people have already engaged their CPA firms and are actively involved in doing audits as of December 31st, 2017. And those will be done by, unless you're using us, they'll be done by the end of April. No, they'll be done by the end of April, even if you're using
no extensions.
No extensions, unfortunately. But which is a problem. There are no extensions. And here's the issue. It is hurricane damage. And like I said, these entities are commercial entities, and they're complicated. And the accounting is supposed to be, by law, on an accrual basis, which means you record the income and expense, the income when it's earned, not when it's paid, and you record the expense when it's incurred, not when it's paid. So, for example, if you had, let's say your roofs are stripped off on your unit, and you've got $200,000 worth of losses, then at that point, let's say, first of all, you were fully insured and had no deductible, which we know is not true because everybody's got a deductible now. But let's say you had no deductible. Well, the question becomes, when do you record that $200,000 worth of expense for the roof, and when do you record the insurance proceeds? Well, under GAAP, on an accrual basis, you would record the expense when it was incurred. Well, when did you lose the roofs? During the hurricane. So that's when the expense would be incurred. So technically, that's the date that you record $200,000 to repair the roofs. And then you would record the income when at the same time. Because when was the income earned? Well, you were insured, so it was earned when you had an event that created a need to pay out insurance money to you. So that is when it was. So you would record both the revenue and the expense as of the date of the hurricane. And so that would mean 2017. Even though the insurance company might not have paid you until January or February. And even though you may not even have started on the roofs yet because you didn't have the money to do them, because the insurance company hadn't paid you until January or February. So that's a little confusing for people because they say, well, we didn't even have the money. Now, it gets even more complicated and creates some exceptions is that what if I don't know how much the insurance company is going to reimburse me? So now it's $200,000, but the insurance company's arguing about it. And, furthermore, I don't know how much it's going to cost to replace it. I think it's $200,000. I've had a contractor out, maybe, but maybe not, because I can't get a roofer out to tell me how much it's going to cost. So my estimate is $200,000, but I don't really know for sure what the number is. So at that point, all I've got is estimates. Well, then what you would do is you would disclose that I don't know how much the income is because the insurance company is, still disputing the claim or whatever. And I don't know how much the expense is going to be, but because I don't have an estimate, but you might have a range. You might say it's going to be between 100 and 400 or whatever, and you would put that information in the footnotes to the financial statements, and that's why the footnotes are very important. But you would put that in the footnotes. Now that's only when the amount of the loss and the income is not estimatable. So you don't know exactly what it is. And that doesn't mean you have to know exactly what it is. You just have to know reasonably close. But if you don't know that, then you just disclose it in your footnotes, and you don't you don't disclose in the basic financials. And in the footnotes, based on what the state requires, you're supposed to also, if it's a loss, you're supposed to also convert that loss to an amount per unit. You have to give some sort of an allocation per unit. What is it going to cost the unit owner if there's an assessment or whatever else? So now I'm going to take it one step further. So under that scenario, there's really nothing on the financial statements, and there's just some discussion in the footnotes. But let's take real world. Let's say that that it's a $200,000. Let's say it's a $200,000 roof damage. You've got a pretty good idea what that number is. It's going to be roughly somewhere, between 180 and 220. So you know what the number is, and you know that it's under your deductible no matter what it is. So the insurance company isn't going to pay anything. So you don't have any revenue coming in to offset it, and you just have this expense. Well, the question then becomes, what do you record in your financial statements? And in my opinion, since the event that caused it, the hurricane, happened in 2017, you incurred your loss in 2017. That's when you lost your roof. That's when the economic value, and that's when it created a need or a loss to the unit owners. And that loss is an X amount per unit, depending upon how you calculate that. And that's something that I think you should see this year. As a board member, I would like you to to know that, okay, this is what's happened. I should see this in my financials. It's actually for you as a board member, it's a good thing, because I wouldn't want to be the board member that was on the board when a unit sold for $300,000 and they looked through the financial statements and there was no discussion of anything. The hurricane didn't exist as far as the financials are concerned. And now all of a sudden you say, by the way, we had $300,000 worth of losses, no insurance proceeds because it's under our deductible, and everybody's got to chip in $30,000. That's not going to be pleasant. So I just mentioned it for board members. You need to be on top of this. I would like to think that all of the CPAs would be on top of this, but that may or may not be the case. Hopefully they are, and hopefully they recognize what the issue is. Some will potentially say, well, I don't know the amount, so I'm not going to put anything in there. That's not the right answer. You had a hurricane, something happened, you're going to have a loss, at least the amount of the deductible. You should have some disclosure there. Keep in mind, that's only the deductible. Think about all the items that are uninsured, the fencing around your tennis courts, the landscaping that they're not going to replace, all of the things that the dune crossover and all of that stuff that's uninsured or underinsured, that there's no way they're going to cover that there's limits on it or whatever. So think about those kind of things. That's going to be a loss too. That loss actually occurred as well. And you may not know what that full amount is, but you at least need to know that you're going to lose the deductible in many cases. So that's something that you need to be on top of with your accountants. Here's the other problem. Let's say you engaged your CPA and you were you didn't even engage your CPA. You're under $150,000. You don't even have to have a compilation. So you didn't do any work this year. You didn't even have a compilation. But you had substantial damage. You're fighting with the insurance company. You've hired Peter's firm to help you get your money back from the insurance company. And so now you've got let's say you've got $700,000 worth of damage. Well, that damage and that insurance accrual, because the insurance company owes you that money, that $700,000 should have been recorded in 2017. So what does that mean? Well, that means instead of doing no work in 2017, you should have engaged a CPA to do an audit, because it's not when you receive the cash that makes a difference on when you're supposed to, on what your revenues are. It's under when it was earned. It was earned when the insurance proceeds are supposed to be paid, which is as of the date of the event. So there again, if you should have accrued that number, your revenues may have been above the thresholds that required a different level of reporting. And that's why the CPA may not have caught it, because they weren't even engaged yet. They're not engaged until next year when you actually got paid the check and you go in and they go in and say, by the way, you know you were supposed to do an audit the year before. So anyway, those are the kind of things that I want to mention, because this is going to be a weird thing. And we had, and here's what's really weird about it, and that's why I think it's so important, is that what makes it important is that we have situations. I have a client where they're side-by-side associations, and one of them had $50,000 worth of damage. $50,000. So that's, on this association, that's basically immaterial. It's not even something to deal with. I mean, there'll be a disclosure, but that's about it. You know, some numbers will go in the financials, but it's not even enough really to look at breaking it out as a separate hurricane fund or anything else. And the other association next door had $900,000. So now if I'm buying and I'm looking at these two associations and I pick up their financial statements and I'm looking at them, and I don't, that information isn't in there because they're recording it on a cash basis instead of accrual basis. And I'm looking at these two units and they're about the same price. And I'm thinking, oh, wow, you know, that's not bad. Well, you know, I like this one over here that has a little better view. So, you know, I'm going to go with the one that's got a better view. So I buy that one, and lo and behold, 3 months later, I get an assessment for $16,000 or $20,000. Well, you know what? I might not like that view that much. And I'm going to be kind of upset at that point that wasn't disclosed to me. I'm going to be a disgruntled owner. I may or may not have the cash to do that at this point because I may have put it down on the unit. I may have stretched a little to buy the unit because I really like that view. And now I'm in trouble. So I can tell you what I do. I immediately call an attorney and sue the heck out of you because you should have disclosed that. And I'm going to want to get out of my unit. So, because I don't trust any of you guys in this community. You're all liars and cheats. So anyway, that's why I say it's not a pleasant thing. And none of us want that because we want to live, we want our neighbors that are moving in to have just as much fun as we are. So anyway, so that's my little dissertation this morning from an accounting standpoint, Peter. I hate to, I know I don't normally go off on these accounting topics. And I definitely don't go off on tax topics because we would have lost them at, I'm going to give you a tax update. So anyway, that's the deal. I don't know if you've seen much of that, Peter. It's, but I'm just starting to, I'm just starting to look at financials, and it's going to be a problem because people don't understand why they got to record these things, and also they don't understand that you got to put the number in there, by unit. You've got to kind of let everybody know what the potential loss is to them. If now. You may not have to come up with that out of cash. The association may have the ability to borrow, but you have a loss, and that loss needs to be reconciled, to the individual units, so that the individual unit owner knows what their percentage of the loss is. And one other thing, and I'll ask you about this, Peter, but I'm pretty sure I know the answer. Hopefully I do because I gave somebody this answer. Back a number of years ago, they tried to increase the limits and require that you have to take a higher limit on the HO6, right? Insurance policies for the loss.
Well, they tried to require owners to have liability, to have insurance.
Right. And at one point they tried
in the Condominium Act.
And at one point they tried to actually dictate the amount. It was like $2,000 or something like that, right? Or $3,000 or something. They tried to dictate the amount. and then they backed off of it because they
Well,
realized.
they backed off the whole insurance thing.
Right.
Basically.
Yeah. So they don't have that anymore. So good. I gave the right
It's
answer.
not basically what the act says is it does delineate between the property to be insured by owners and property to be insured by the association. And what they had in there for like a year was, the owners must prove that they had, I think it was maximum insurance value. Anyway, but that they were insuring their, their contents and the parts of the units that they were required to insure. And if they didn't have the proof of insurance, then the association was permitted to force place it. In other words, they were permitted to go out, get the insurance, and assess the owner. The problem that we face this is about, I don't know, I'm so bad with the time frames here. I don't know if that was 6 years ago or something like that.
Yeah.
And what happened was the insurance company says no, they want to play ball, and we're not going to force place, and we're not going to insure the units in essence through the association. And so it fell apart, and then that part of the statute was rescinded. Was deleted. So now you do see some associations, and some of mine will amend their declarations to mandate that owners carry insurance.
Right.
I still think there's some enforcement issues there because.
Yeah, you can't keep
even if you require the owner to give you a certificate of insurance, they can still go cancel it the next day. And I'm not saying there's no remedies, but it's not.
Unless you're a named insured, and that can be a pain in the rear. That's impossible. And most insurance companies won't do that. So
anyway, that's a long answer to your question. So there was some insurance mandate in there briefly, but it didn't last very long.
Well, and they also, I think, tried to mandate the loss payable amount for the assessments. And I think they tried to do that as part of that. And what they found out is that the insurance companies wouldn't even make that available. So they tried to make it a requirement.
Well, there is loss assessment insurance now. That's been in the last couple of years.
Yes.
Where there's a $2,000. The insurance companies must offer owners this loss assessment coverage, which basically covers special assessments with respect when the proceeds are short because of a deductible or whatever.
Right, and that's only $2,000, correct? I mean that's
a minimum.
Yeah. And that's what
I guess you could get more if the carrier was offering more.
Yeah, but I don't think that, but the law doesn't require any more. That's the thing, and that portion of it, that was the problem, is that the insurance companies weren't offering anything for a while over $1,000, and that's why you couldn't get it even if you wanted it because the insurance companies weren't offering it. But anyway, so that's the so even if you've got it, if you're going to have most people are looking at deductibles on wind that are going to be in excess of
it's 2 to 5% usually.
Yeah, it's running somewhere in that range, 2 to 5%, and it's going to be high enough that, and it's based on the insurable value, which is a bigger number. It's maybe not as big as the fair market value of each unit sold out individually, but
it's the replacement cost basically.
Yeah. So it's still a big number. Mm-hmm. And that's going to be so if you've had significant hurricane damage, you may not know what the total is going to be, but if you know the total is above your deductible, I would at least disclose the deductible amount that you're going to lose in the current financial statements, because there's nothing that's going to change that. No matter what the insurance company pays, they're not going to pay the deductible. So, if you know that your loss is in excess of the deductible, you at least disclose the deductible. Now, and that was the other thing that comes up. Some CPAs look at this as one set item. They say, okay, I don't know how much it's going to be in total, so I'm just going to disclose it. I'm not going to put the loss on the financial statements. But there's components to this. There's the deductible portion of it that you're going to incur if you've had a loss at all. So if you may not know what the total loss is going to be, but that doesn't mean that you don't know what the loss is from the deductible. And that's a whole separate thing. So that is, you are able to estimate that. It's in your insurance policy. If you've had, if you know it's going to cost, because you've done roofs, it's going to cost $100,000 a roof, and you've got 8 roofs that have significant damage and are going to have to be replaced, then at the same time, you're going to be above your deductible if your deductible is $400,000 or something. So make sure that you look at those items and allow for them. And the other thing that's happening here, and this is the last thing I'll say about this, but I've been harping for a while, Peter, on reserves, and usually hurricanes have a tendency to save. In the last hurricane, 2004 and 2005, but in 2004 here in our area, that hurricane really saved a lot of associations because they didn't have any reserves. Their properties were getting to the point that they needed to have some work done on them, and they got it all done for $1,000 or something. The deductibles back then were really low, $5,000, $1,000, or whatever. But nowadays, you got a situation where people are trying to stretch. They're maybe trying to go another 2 years on that roof, and that hurricane hit and destroys the roof, and they're going to have to be replaced. And frankly, if you haven't replaced them and they should have been replaced, the insurance company isn't going to insure them even if they were insurable because they weren't maintained correctly. In other words, they're going to look at that and say, well, this roof was damaged to start with. It was needing to be replaced right away. So therefore, we're not going to cover it, or we're not going to cover it to the full amount. And then you still got the deductible. So some people are looking and saying, I don't have my reserves. I don't have enough reserves for this. I'm going to have to special assess. So you may create, even though you didn't have substantial hurricane damage, that it may have sped up your need to replace certain items. So when you look at your reserve schedule this year in the budget, where the life may have been 7 years left, now it might be 2. For example, painting. You may have 7 or 8 years in painting before you had to paint again, and now because of the blown sand and the water and everything else, it sandblasted your building, and you're going to have to repaint it. So some of those kind of things are, items that you're going to have to do faster than you anticipated, and they could all be under the deductible. And these are all things that are caused by the hurricane and actually should be disclosed if it was something that affected the association. And, the thing that bothers me is to have a set of financial statements that don't even mention that you had a hurricane that happened. At least have some discussion of it and what happened and what some of the issues are. But anyway, so that's the big thing I see going into this year for financial statement purposes is reserves now exacerbated by the hurricane and what associations are going to do or not do and what they're going to disclose and not disclose about these items. So it's going to be interesting. What do you got going on, Peter?
What do I have going on?
You've probably got a lot of stuff going on this time of year. This is annual meeting time and all kinds of good stuff. People not sending out their notices correctly. And, you talked about it last week, and it's probably good to at least discuss it one more time because I know people are doing this. But, I just found one, I just was dealing with one situation where the property management company has not they didn't do the annual meeting correctly 2 years in a row, to the point that the state now won't let them conduct a meeting without a state representative present. So,
without a election monitor there?
Well, or without somebody present to make sure that the meeting notices were done correctly and everything. They didn't do any of the stuff that they were required to do for some reason or another. We've had a lot of rapid growth in the industry. A lot of people have moved out of the big associations to smaller to smaller property managers. They moved out of the big property management companies to the smaller ones. Big property management companies are, leaving the area to a large degree. And so a lot of people are bailing. There's been a big opportunity. So some of this is just a question of smaller property management companies having difficulty keeping up with the growth, and they bite off more than they can chew. And, it's, and I know it's tempting. My son's in the property management business. It's tempting to go out there. I mean, it's kind of low-hanging fruit in some cases. There's, and they have a good property management company, but, good property management company can become a bad one quickly if, you double or triple the amount of business you have and don't have the people to do it,
Well, you're right. I mean, this is annual meeting time, and most notices have gone out. Because the first notice, again, we're talking condominiums now, must go out 60 days in advance. So, if your meeting is in, February or March, and presumably your 60 or even April, your 60-day notice, has gone out. Anyway, I mean the law is very specific on that first notice going out 60 days in advance. The second notice going out not less than 14 days in advance. Plus your information sheets. And it's true if you mess it up. Now if you mess it up, at least there's a fairly short window for owners to challenge it. They only have 60 days from the date of the election to challenge the election. But one thing that people tend to sometimes forget, I don't know if they forget or it's just not checked into. But both for HOAs and for condos, if any eligible person or someone who was otherwise eligible is delinquent in paying any monetary obligation to the association as of the deadline to submit your name for a condo, or the last day you were able to nominate yourself or to be nominated for an HOA, if you're delinquent, then you're not allowed to be on the ballot. And I think, it's probably incumbent upon management companies, property managers, to check and make sure that everyone who's turned in their name as a candidate or has been nominated, if you're in an HOA, to be a candidate, is actually eligible under the documents as well as eligible under the law. And I think sometimes that is forgotten, to check to make sure that they are current, because that would include it includes any monetary obligation. So that would be not just assessments, could be fines, could be other obligations to the association. I think that's something that sometimes either gets forgotten about or not really focused on.
Yeah.
But I've had it come up a few times recently. So
along those lines, since you're on the election part of it, what if I know if you've got an equal number of candidates running for an equal number of seats,
there's no election.
There's no election. What if you have a minimum, a board of, let's say it's a range 3 to 5, or let's say 3 to 5 or 5 to 7 or something like that, and let's say you have nobody running. Nobody will run. And now you've got, let's just throw that out there. So you can't get anybody to run. You've got maybe one person that will agree to run or stay on the board or do whatever. But nobody else will agree to stay. Nobody else will agree to run. Maybe some people have moved. But what's the requirement? What do you do in that situation?
Well, you need enough people to serve to constitute a quorum. Okay, I mean, I've always looked at it. Maybe maybe this is right, maybe this is wrong. Most bylaws say that your term shall expire upon the annual meeting, or until your successor has been elected. And typically, if you have no one who wants to run and the people who are on the board still are willing to serve, I say that they roll over until someone steps up. In other words, that their terms are in essence continuing.
even if they don't qualify, even if they're
Well, no, they still have
if
to
they
qualify to be on
moved
the
or they
board.
passed
No,
due. Okay.
no. They still have to qualify to be a director. Okay.
Okay.
If you don't have enough eligible people to serve on the board to constitute a quorum, then anyone in that community can file a petition to have a receiver appointed. No,
Right.
they still have to be eligible to serve on the board under your document. So if your documents require that board members must be owners, then obviously the board members must be owners. Okay.
Right. Okay.
If they're more than 90 days delinquent, then they're deemed to abandon office. If they've been convicted of a felony, whatever. If there's some reason to disqualify them, then obviously they can't serve. So I'm talking about people who are otherwise qualified to continue to serve.
So, and then, so you're saying you have to have, and by law, a condo association and or an HOA, are under 617. They're required to have three three officers.
No. I mean, basically, you have the number of directors that your bylaws provide or your articles, depending.
Okay.
If they're silent, it's 5. If it's 10 or less units, then it's 3. But you need a quorum. So if you have a 5-person board, you got to have 3, right?
Okay.
Enough people to constitute a quorum.
3-2.
3-person board, you would need 2 people willing to serve.
Okay.
So you have to have enough people willing to serve who are eligible to constitute a quorum.
Okay.
Under whatever size board you may have under your documents or by law, depending on.
So is it officers that you're required to have as a nonprofit? You're required to have 3 of those?
No, not
Okay.
officers. You have to board members.
Okay.
I don't care so much about the officers.
So you can only have one of those. So if somebody doesn't want to, somebody says, "Yeah, I'll be a board member, but there's no way I'm going to be a secretary."
You have to have a board to function. Okay.
Mm-hmm.
I
Right.
mean, officers. You probably will need them, at least someone to sign some documents, right?
Right.
But to actual function as a corporation, it's the board members that you have to have.
Yeah, because I was thinking under 617, under the corporate guidelines, you could have one person be all of the officers. They can be president, secretary, treasurer.
Well, it depends upon your documents. You could theoretically have that, but most documents, have limits on how many different offices that you can hold.
Yeah. Okay. I just, it's interesting because.
I think 617 says president shall not also be secretary.
I think there's a
either secretary or treasurer. I think it's secretary.
Yeah, I think there's a provision that you have to have more than one in the 617.
But again, it's really the board members that you need to avoid having to go into receivership.
Right. Now, if you go into receivership, or if you don't automatically go, that's the confusion.
No, someone has to petition.
Somebody has to petition.
No,
so
nothing happens automatically because no one knows.
Right.
There is no. There's no automatic.
But when you file your bylaws, when you file your annual report with the state, and you don't have any directors listed or one director listed, doesn't that trigger anything?
It's probably going to trigger your annual report's not going to be complete, so you might get administratively dissolved. Okay,
uh-huh.
but they're not going to put you into receivership.
Yeah. Okay.
It's the division of corporations is not.
Yeah. Anyway, it's an interesting situation, and I know people out there don't want to serve sometimes, but you need to avoid this situation. People just
you want to avoid a situation where you don't have enough people willing to on the board to constitute a quorum. It means eventually you're probably going to end up in receivership through someone in the community going to court. And that means, you have attorney's fees or potentially attorney's fees, but what you eventually may end up having is the court appointing a receiver, which means now you got to pay the receiver a salary.
Right.
And
it's not going to be cheap. Yeah, it's not going to be cheap.
And it's not going to be free.
Yeah. And
I haven't personally seen it happen. Okay, I'm doing this a long time. So, it is a potential, but typically, an association will somehow manage to get enough warm bodies, hate to say that, but, enough people to serve, so at least they can continue to function.
Now, see, I would volunteer in my association to serve, but there's restraining orders against me, so I can't attend any of the board meetings. It's just, I kid, but I think I know of an association where that's the case. They're not allowed to.
Maybe there should be some restraining orders.
I know there should be.
Gag order.
That's right, gag orders, restraining orders. So anyway, well, okay, good. I'm glad we went through that, and I'm going to ask this or deal with this question, and because Frank here's got a question. It's a good one, so I'll just talk about it. A little bit off the subject, but relative to insurance from our last discussion. What happens if you're no longer in a floodplain? We had the flood maps redrawn, and sometimes we got the worst scenario where you went into a floodplain where you weren't, and so all of a sudden, you've got flood insurance and it went through the roof, and assessments went through the roof, and all of that kind of thing. But what happens if it went the other way? You've got flood insurance. You've got money put in you've collected money for flood insurance, and now you don't need the flood insurance. The question that he has is, does the money have to go back to the unit owners?
No.
So you just get to keep that money, even though it may have been assessed for that?
That is money. I mean, assuming, again, I'm not sure whether I would cancel the flood insurance anyway, because sometimes you have floods in non-flood zones. But assuming you cancel your flood insurance and your documents permit that and everything else is fine, I mean, that's on your operational side. So that money can be used for any operational expense.
Right.
Okay. You may want to amend your budget, to decrease the budget, because
it is a taxable event potentially. You're going to have you potentially may have to pay taxes.
But generally speaking, surplus funds are not paid back to the owners, except for special assessment surpluses. So you're either going to possibly amend your budget to reduce the budget for the rest of the year, or you'll apply that money maybe to some other needs. You may be under in some other categories, right? So rather than, so you would just switch that money to that category. Maybe there's a maintenance expenses might be up, your legal expenses might be up, your accounting expenses might be up.
Yeah, they should be up, man.
Yeah, they should be up.
Way high.
So use it for that, or at the end of the day, if you do have a surplus at the end of the year, rolled it into the next year's budget, with the tax issues that come into play there. But I don't think writing checks back to the owners is, I would never advise that.
How about moving that to the reserves, Pete?
The board could apply that to next year's reserves.
Yeah,
that
does not help you for tax purposes, by the way.
I would wait until the end of the year before I start switching money to reserves, because you just don't know. Again, you may need that money.
You just had a hurricane.
As the year goes along, because stuff happens, and these budgets are just guesstimates, and so I wouldn't do any kind of, and Mark can address. I don't know if it's time, but Mark can address the tax implications. But I wouldn't be switching money into reserve accounts until the end for the next year's budget, when I knew exactly how much I was going to, how much surplus that there was going to be.
Right, and that is the case. It's it's the mistake a lot of associations make, is they wait to see how they're doing at the end of the year in the operating, and then they transfer the surplus over to reserves. The trouble with that is that all that income is taxable, whereas if it had gone to the reserves to start with, it wouldn't be taxable.
Oh.
So
no, maybe I'm wrong then.
No, you're right. You're right. I mean, you do have that election, is what you're talking about, the 7604 election, which allows you to, and it depends on what kind of tax return you file, but you do have a 7604 election that allows you to, apply it against next year's assessments to avoid tax on it. But I see associations all the time that think that if they transfer it to reserves, it's not taxable. But under the way the tax laws are written, you have to know that money's going to reserves to a capital to start with. The reason it's not taxable when it goes to the reserves is it's considered a capital assessment, not a operating assessment. And so capital is not income. It's not taxable under the tax laws. So if I make a capital contribution to a business, I don't pay taxes on that because it's not income. And that's the same theory here for reserves. The money that's going into, that's why if a portion of it's going to painting reserves, which is a non-capital item, it is taxable because it's a payment for an operating expense or an operating item, not a contribution to capital, at least under the tax laws as they stand right now. So that's why you have to, but one of the requirements for it to be a capital is you have to know you're making a capital contribution. If you think you're making an operating contribution, at the end of the year they transfer it to reserves, it doesn't become a capital contribution then at that point because you didn't know. There are ways to rectify that. One of the ways is to refund it and then assess it. And you can do that without cutting a check. It's a process, but it's worthwhile sometimes. Is you send out an invoice, a credit memo showing that you're giving them a credit against their. So what you do is you assess them for a reserve contribution, and then on the same thing you give them a credit memo for a refund of money, and so they have a zero. They have a zero invoice that they get, so they technically pay it by using the credit, but they had the ability. They got it back. They just also got a credit allocated to them at some point. So, I've done that before when necessary to solidify some sort of a capital contribution just so that people can see that it did occur and there's paperwork on it. The other thing on speaking of those kind of items is that I don't know if you're running into it, Peter, but we're up here. Comcast is putting a big push on trying to get people to extend contracts, and at the same time, places like AT&T and DirecTV and that are coming in and trying to get people to sign new contracts and switch.
Yep.
And there's also a lot of people out there doing, trying to get additional cell tower capacity, particularly since, and it's kind of interesting, Comcast is now going and offering wireless services. They're trying to offer basically wireless services. And I think they're I'm not sure, but I think they're kind of doing that by Wi-Fi connections with cable hotspots. So what's happening is you basically transmit to a Wi-Fi, which is similar to what happens with a cell tower. You may be on a cell tower, and then as you reach outside the area on the cell tower, you switch to another cell tower, and hopefully you don't drop your call and everything else. Well, I think Comcast is doing the same thing. But what they're doing is going from a Wi-Fi connection that's connected to the internet at that connection to an additional Wi-Fi connection that you pick up. If you think about it, it's the same stuff. It's just instead of it being a constant wireless transmission, a portion of it becomes a internet connection, and you're just connecting over the internet to connect the calls. And so Comcast is also looking for internet capacity or for connection capacity, tower capacity, to be able to make connections on these things and hotspots and that kind of thing. So, again, you need to look at how you record those. If you sign a lease with Comcast or Verizon or one of those places to allow them to have access to put up a tower, that lease is going to be taxable income to you, to your association, and you're going to have to pay tax on that. And it's non-member, so no matter what tax return you file, you're going to pay tax on it. So the key there is to get a good attorney like Peter to work with the company to get a easement.
You're always pushing the easements.
I know, because I've just this last week saved.
It's his new favorite word.
Well, I saved an association down in Fort Lauderdale about $200,000 in taxes by getting them to do it as an easement, and so it is a deal, and it is something you want to do. And they'll do it, but it requires a push. So make sure you get, when you're looking at these contracts, and that's why I say when you're looking at these kind of contracts, you need to talk to your attorney. Call in Peter, call in your attorney, talk to them about what you're doing, because they may occasionally have a good idea. And so you may want to discuss it with him. Anyway, looks like we're out of time. Frank played the music, so we'll be back next Monday between 9 and 10 o'clock here. If you've got some questions that come up, or maybe some things you're discussing, maybe you went to an annual meeting, you got a question, let your friends know about it. Join us next Monday right here on WSTU, and we'll talk about it. If you've got a question, you can be anonymous. We'll take your question, and we'll try to answer it the best we can, because we got Peter Mullengarden, and he is fantastic. And so you need to call and talk to him and get the answer, because we're WSTU Digital 1450, Martin County's Heritage Station.